Fast-failing Silicon Valley Bank and Signature Bank could have been textbook examples of traditional bank runs, in which a large number of depositors remove money from a bank at once. With the collapse of Washington Mutual in 2008, the failures at SVB and Signature were two of the three largest in the history of American banking. How is it possible that this occurred while the banking sector has been sitting on record amounts of excess reserves, or cash retained above what regulators require? Although a rise in loan defaults, or credit risk, is the most typical sort of risk faced by a commercial bank, that is not what is occurring in this case. I think it comes down to two major significant risks that every lender faces: interest rate risk and liquidity risk. And I say this as an economist with experience in banking. Interest rate risk. When interest rates rise rapidly in a short period of time, a bank suffers interest rate risk. In the United States, that is precisely what has occurred since March 2022. In a bid to control rising inflation, the Federal Reserve has been rapidly raising rates, by 4.5 percentage points so far. As a result, the yield on debt has increased proportionally. In March 2023, the yield on one-year Treasury bills issued by the U.S. government reached a 17-year high of 5.25%, up from less than 0.5% at the start of 2022. The 30-year Treasury yield has increased by approximately 2 percentage points. A security's price decreases as yields rise. As a result, the market value of previously issued debt, including government treasury bills and business bonds, plummeted, especially for debt with longer maturities. For instance, a 30-year bond's market value may decrease by about 32% as a result of a 2 percentage point increase in yield. A sizable portion of Silicon Valley Bank's assets, around 55% of its total assets, were held in fixed income securities including U.S. government bonds. As long as the owner can hang on to the security until maturity, when it may collect its original face value without incurring any loss. Interest rate risk that causes a decline in market value of a security is not a major issue. Over time, the unrealized loss gradually vanishes from view on the bank's balance sheet. However, the unrealized loss turns into an actual loss if the owner is forced to sell the security before it matures at a time when the market value is less than the face value. That's exactly what SVB had to do earlier this year when its clients started withdrawing their deposits amid expectations of even higher interest rates, as they dealt with their own liquidity shortages. This brings us to liquidity risk. The danger that a bank won't be able to fulfill its obligations when they are due without suffering losses is known as liquidity risk. You're facing a consequence of liquidity risk. For instance, if you spend $150,000 of your savings to buy a property, and later require some or all of that money to handle another emergency. Now that a sizable portion of your money is invested in the house, it is difficult to convert it to cash. Clients of SVB were withdrawing deposits faster than the bank could cover them with cash reserves, so it opted to sell $21 billion of its securities portfolio at a $1.8 billion loss in order to meet its obligations. The lender tried to raise more than $2 billion in new capital as a result of the drain on equity capital. Customers of SVB were shocked by the request to increase equity because they were beginning to lose faith in the bank and were rushing to withdraw cash. Particularly in the digital age, a bank run like this can force even a strong bank to go insolvent in a matter of days. In part, this is because many of SVB's customers had deposits well above the $250,000 insured by the Federal Deposit Insurance Corporation, and so they knew their money might not be safe if the bank were to fail. Roughly 88% of deposits at SVB were uninsured. Signature faced a similar problem, as SVB's collapse prompted many of its customers to withdraw their deposits out of a similar concern over liquidity risk. About 90% of its deposits were uninsured. Systemic risk? Due to the Fed's rate hiking program, all banks currently have some of their holdings exposed to interest rate risk. As of December 2022, this had caused unrealized losses on bank balance sheets of $620 billion. So it's unlikely that the majority of banks face a serious liquidity concern. SVB and Signature complied with regulatory requirements, but their asset mix was out of sync with the norm for the sector. Compared to the industry average of 13%, cash made up 7% of SVB's assets and slightly more than 5% of those of Signature. Moreover, SVB's 55% allocation of assets to fixed income securities is higher than the 24% industry average. It should be less likely that banks with less cash and more securities on their books will have a liquidity shortfall, due to significant withdrawals prompted by unexpected panic. As a result of the U.S. government's decision to support all deposits of SVB and Signature regardless of their size, Yet, I think the banking crisis is far from ended because there are still over $1 trillion in uninsured bank accounts.